Good morning. Welcome to America First Wealth Management Investment Outlook. Here we are at the last week of August, August 26th. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. Joining me again today is Michael Cheah, our Head of Fixed Income and Portfolio Manager. And this is our outlook for the week of August 26th. Next slide, Mike. This is our standard disclaimer. We're not offering any investment advice. We're just giving our views on the markets and outlook, and our views are subject to change depending on what happens with the market and other conditions. Next slide, Mike. So, as usual, we begin with our conclusions first, so viewers can see what we're thinking up front and allow for time to look at our more detailed information that follows. So my conclusions are that on Friday, Powell gave his Jackson Hole speech, and it was entirely dovish. In fact, there wasn't a single sentence of hawkish statement that I could pick up, and it was clear that the Fed is prepared to lower interest rates. However, the timing and level of cuts are uncertain. Whether or not there'll be 25 basis point cuts or 50 basis point cuts depends on what the Fed is concerned about at the time or trying to accomplish. The U.S. 10-year yield continues to decline. It's near 14-month low, and U.S. new home sales increased to over a one-year high last week, and this is also very encouraging. However, the surge in credit card delinquencies that we've been talking about continue to rise, and that's concerning. In fact, they're up at levels that have occurred during past recession. Another interesting event that's occurring is the dollar continues to decline, and gold has been rising very strongly. And this raises questions about confidence in the U.S.'s ability to manage its balance sheet and debt service. The big event on the corporate front this week will be NVIDIA earnings on Thursday, August 28th. They're likely to be strong, but everyone will be focused on their outlook. There were some delays that they announced previously with their new Blackwell chip, and any additional delays could cause a stock and market hiccup. And then there are some key macro events for the week on Monday, Thursday, and Friday, as noted here. Next slide, Mike. As I mentioned, U.S. home sales have jumped, and it's the highest now since May 2023. So that was clearly evident in the rally in real estate stocks during the week, which we'll talk about later. Next slide, Mike. And the credit card delinquencies chart looks like this. And you can see that clearly we're at levels that have occurred during prior recessions in the band there. So that's something we want to watch carefully for. 2 weeks ago, we saw a very strong retail sales number, which kind of bucked the concern that the credit card delinquencies were showing. So it remains to be seen if retail sales will continue to be strong in light of credit card delinquencies rising. Next slide, Mike. This is the gold versus dollar year-to-date performance, and you can see the dramatic rise in gold, and it's also occurring in gold mining stocks as well. And we see the decline in the dollar. The dollar is now negative versus other currency baskets year-to-date, and it may indicate a shift to a neutral policy by the Fed, which should possibly signal continued decline in the dollar and perhaps a rush to real assets such as gold, silver, and other hard asset plays. So we're watching this one carefully. Next slide, Mike. Turning to weekly market stats, we saw a relatively strong bounce during the week, led by small caps Russell 2000 index of 3.5%. We also saw a bounce in international stocks up over 3%, and the larger cap indices were also up. NASDAQ was flattish for the week. largely due to specific names in the NASDAQ, but it still remains very strong on a month-to-date basis. On a quarter-to-date basis, though, NASDAQ is the weaker of the major market indices, down 1.6%, quarter-to-date for the NASDAQ 100, and down 1.45 for the NASDAQ Composite. So there does seem to be a drop in some of the leadership names in the NASDAQ, but the broader market indices are still holding up well. Next slide, Mike. As we noted, the 10-year Treasury yield is now dropped below its beginning of the year levels. We're down at 3.81% on the 10-year yield as of Friday, down 8 basis points for the week, and down 7 basis points year to date. And again, we're showing that 10-day moving average, which has been a very good signal for the 10-year interest rate. So it's still showing a bullish sign here by staying below that moving average. So we're going to watch that to see if it continues. Next slide, Mike. The yield curve. Here we added last week's yield curve. The current yield curve is the light blue line at the bottom. You can see a decline pretty much across almost all maturities except the very long end at the 30-year range. But we do see a clear decline in the yield curve. We're still inverted, however, but the drops are bullish, and the short end of the yield curve, it will be affected by what the Fed does hopefully in September. Next slide, Mike.
All right. Okay. Thanks, Dan.
I'll return it to Mike. Yeah.
Yep. So my conclusion is the whole idea that the FOMC decision to signal a cut in December is a preemptive move because yes, the job situation, the job numbers were revised downward, but in terms of unemployment rate, we are still in a very tight labor market, and we're not hearing about companies talking about laying off workers. And there's still indication that the economy is not yet in a recession. So this is a preemptive move by the Fed, right? There is a risk that the easing itself is going to trigger another huge run in the stock market. Effect recreated another run up in the housing market. Effect created, and banks would be encouraged to lend money, right? So there is a danger that the Fed is risking a reacceleration in inflation. Not unusual. This was a mistake done by Arthur Burns in the 70s, and it'd be interesting to see if history repeats itself. For the bond markets, an important question now is how low can bond yield go down when money moves back to the stock market in a situation where we are going to see rising fiscal deficit, and chances is that with the Fed cutting rate, the dollar could be weaker. So, so that's the risk that we are seeing, right? And here are some of the details. Well, we have this non-farm job creation for 12 months through March revised down by 818,000 to 2.08 million jobs created, right, from 2.9. This is a huge downward revision. This revision, this annual revision, is not something new, except that this year, the revision is one of the largest that we have seen in the past. So yes, it makes sense for the Fed to acknowledge this. Again, I want to emphasize that in terms of the unemployment rate, we are not yet in a dire situation, right? We are not yet in a recession. This is the same chart that Dan has shown, and I just want to add on to the credit card number that the prime auto loan and subprime loans are also facing a higher delinquency rate. Inflation, Well, this research have done a very interesting approach where they were able to split the inflation number into structural and non-structural, right? Based on this research, it looks like the structural CPI has stalled, right? What we are seeing is a headline CPI driven largely by cyclical component. So as I mentioned just now, if the economy were to reaccelerate, then we are going to see the cyclical CPI moving up again. The question then is, what would the Fed do? Well, before the Jackson Hole meeting, there were enough hints in the FOMC minutes of meeting, and they talk about how it's appropriate to ease policy at the next meeting. And also that they see the gradual easing in the labor market condition could transition to a more serious deterioration. The market has talked about a possible 2% cut in rates over the next 12 months. And that's understandable because when we look at the real Fed funds rate, right, with inflation coming down, Fed funds rate remaining at the 5.25%, 5.5%, we are now seeing a much tighter real interest rate environment. And therefore, to bring it to neutral, it does make sense for the speculation that the Fed could cut by 2%. Having said this, if the core CPI were to reaccelerate on its own, real Fed funds rate would decline by itself. Okay, right? And if the Fed were to cut rate, by the time when core CPI goes up, then we could get back into negative real Fed funds rate very quickly. Adding to the FOMC minutes, it's quite clear that the Fed is less concerned about inflation and focusing more on unemployment. So according to the Fed funds contract, the market is now pricing in a full percentage point cut by the end of this year. So we have 3 meetings. So likely to see a 25, 25, and a 50. This is what is priced in the Fed funds market. Bond market. Well, I continue to be very concerned about the lack of any effort to try to control the budget deficit. And as you can see here, the high budget deficit that we are seeing is happening despite the economic boom and the low unemployment rate. So what does it mean for going forward? Well, going forward, if the unemployment rate were to rise or the economy goes into recession, then we're going to see even higher budget deficit, right? So this is obviously bad news for the bond market. So I would watch the 30-year long bond yield very closely, despite all the expectation of Fed cut. There is a chance that the 30-year would react negatively and the yield at the long end continue to move up, despite yield in the front end coming down. A dollar, as Dan had mentioned, we are seeing a reversal, and the dollar against the yen has been weakening. Dollar against the euro has also been weakening, right? And if you take a longer term perspective, the trade-weighted dollar is still on the very high side, meaning overvalued, and there is a lot of room for the dollar to weaken. And if the dollar weakens, that would bring complication to the Fed decision. All right, Dan, back to you.
Yes, want to make a comment, Mike, on the jobs number revision, which occurred midweek last week, that minus 818,000 you talked about. It was kind of surprising because there was indication that there would be a big revision on that last Sunday. In fact, I heard reports that Goldman was leaking that and was causing concern about the markets on Monday, but apparently the market seemed to absorb it pretty well. And by the time of the revision, there were some rumors about the revisions would be as high as 1 million versus 818,000. So when the 818,000 came out, there was relief that it wasn't as high as 1 million, but nevertheless, it was a big revision number and quite surprising. And given that the market seemed to ignore that, and Powell masterfully eased market concerns with his speech on Friday. The market seemed to shake it off. And I have to note that if those circumstances didn't exist, the lack of a leak and no Jackson Hole speech, the market probably would have taken that news quite fearfully and probably would have sold off. So timing and bad news is just as important as how it's when it's released and what comes out. So I think that there were some forces in play to manage the release of that bad news. So anyway, that was just a comment on what it is. And moving on to the Magnificent Seven returns. For the week, you had 5 of the 7 names up, and the 2 that were down were just down slightly. NVIDIA led for the week. I think investors are jumping in anticipation of the earnings release this week. And for quarter to date, kind of have a mixed bag. We have 4 out of the 7 names up and 3 down, and a bit of a divergence there. Year to date, all the names are up except with the exception of Tesla, which is down 11.3%. Next slide, Mike. For the sector performance, as I mentioned, with the drop in the 10-year rates and the pickup in new home sales, real estate led for the week, up 3.6%. And looking good month to date, quarter to date, and up double digits year to date as well. Consumer discretionary was second best performing sector, followed by materials. And pretty much we had strong performance with the exception of energy, which was down. And we'll note later that energy futures prices were down, which drove the decrease in energy. Despite the strong week in the market, technology was near the bottom in terms of performance. Positive, but near the bottom relative to the other sectors. It's nice to see some of the breadth into the other sectors, because in the past we've seen tech pretty much being the largest leader. It's also nice to see financial sector and actually outperforming technology, which is kind of refreshing to see the breadth. Utilities also being up there among the leaders, second best performer. The top performer is communication services sector. Next slide, Mike. Factor performance leading the week was the IPO factors. Spinoffs were second, and private equity factors was third. Under style, big resurgence in small cap. We sorted in the Russell 2000 increase for the week. The style factor performance was very strong as well. Value stocks showing a resurgence. Large value up second for the week, followed by dividend stocks. All in all, a good week, but we're seeing some divergence in factor results, which is quite encouraging to see that breadth. Next slide, Mike. The commodities, as I mentioned, the Energy commodities largely all down. The only one that was up was ethanol. Nat gas and crude were down. Uh, uh, for that percentage move, it's significant for those commodities. And we can see nat gas is down a lot, down year to date, 12.8%. And we're likely to see a lot of switching into natural gas by the electric utility companies to take advantage of low natural gas prices. So we don't expect that to remain low, and it could be an opportunity in some of those natural gas names. On the metals front, we're seeing a rebound, aluminum and steel, and across the board, silver, gold, and copper up as well. So a pretty good week for the metals commodities, bad for the energy commodities. Next slide, Mike. The ag commodities, we're still seeing a strong numbers for cocoa, and many of the food commodities are seeing decline. You see beef, wheat, and corn are down. Surprisingly, lumber was down for the week with the strong pickup in new home sales. Usually lumber and real estate move in the same direction. So surprising drop in lumber. And yeah, that's pretty much it for the agricultural commodities. And let's go turn to the next slide, Mike. Economic calendar, as I mentioned, on Monday, we got durable goods orders, month over month. That'll be the important macro data points for the week on Monday. Next slide, Mike. This is Wednesday, which is kind of typical. A lot of the mortgage data and energy commodity inventory numbers. So those tend to be interesting, mainly for the commodity markets. We know that the mortgage rates are continuing to decline with the 10-year drop, so that shouldn't be any surprise there. We do have a couple of auctions that'll be worthy of watching, and we expect the demand to be there. These tend to be the shorter end of the auctions, where rates are still high relative to longer, so we expect those auctions to come off pretty well. Next slide, Mike. Thursday, we got the GDP growth rate at 8:30 a.m. That'll be an important indicator of the economy. The consensus is for 2.8%. Previous 1.4. The forecast is also 2.8%. Next slide, Mike. Friday, we have core PCE price index will be hopefully be a confirmation of inflation coming under control, consensus 0.2%. And we also have personal income and personal spending. Those will be important indicators for consumer strength and harbingers of retail spending. And that pretty much wraps it up for the week in terms of macro information. Turning to the S&P 500 corporate earnings, we're kind of winding down on earnings season. Tuesday, Catalent, Wednesday, the list goes down. The important one we're all going to be watching aftermarket on Wednesday the 28th is NVIDIA. Looking for consensus earnings 64 cents versus a year ago 37 cents. I'm sorry, that's up 37 cents from a year ago. So it's pretty aggressive earnings expectations, but I think channel checks are suggesting that NVIDIA should be doing very well relative to consensus estimates. As I mentioned earlier, it'll be what they talk about regarding the outlook and the Blackwell chip. People will be watching that carefully. And also a couple of other tech company earnings, HP, NetApp, and Salesforce on the software side. And Salesforce will be an interesting one to watch because Salesforce strength is usually an indicator of companies willing to spend on sales productivity, and if companies are feeling strong that their sales cycle could be increasing, companies will add salespeople. That usually leads to more licensed seats for Salesforce. So that's also a good indicator of corporate outlook by following what's happening with Salesforce. Next slide, Mike. Wrapping up the week. Just earnings on Thursday. We've got Best Buy will be a good bellwether name to watch for consumer electronic sales. And Best Buy will probably give a good indication of what the back to school technology demand looks like. And we've got Dollar General, Autodesk, Lululemon, Ulta Beauty, and Campbell Soup. And that wraps up the week in earnings. And that leads us to pretty much our close here for the week. Any of our clients and interested financial advisors would like to get more information about our products and services or to schedule a one-on-one call with us, as always, we do offer that service as opposed to larger companies in the industry, which probably don't want to spend time to talk to clients. We have the experience in doing so. We're comfortable, and we learn a lot by talking to our clients and prospects, hearing their concerns and interests, and we're always there willing to help. And I want to take a moment to mention that Mike and I are planning to do a more detailed webinar on September 10th at 1 p.m. Eastern Time. And if there are any interested parties that want to sign up for that, please contact Cleveland Ashley. His information is listed here. And that's going to be an interactive webinar and give participants chances to ask questions in real time. And if we have enough participants, we're also going to be polling participants on what they think about the market outlook. So if you want to join us, you're welcome to reach out to Cleveland and he'll get you on the roster. And with that, that closes it out for me. And Mike, maybe you want to add anything?
No, just happy Labor Day, and hope to see you guys soon.
Okay, thank you. Signing off. This is America First Wealth Management. Take care.